Hey, what's up, Mike? Moose, Mike from the Moose on the Loose. I hope you're doing well today. Today talking about dividend growth investing. Is it still relevant in 2025? I get that question a lot these days because people are saying, Mike, I mean, you keep on focusing on the same strategy, but you cannot even keep up with the S&P 500. So what's the point? Why are you still using a strategy that is getting beaten up by the S&P 500 while the only thing that you should do is buy a broad ETF covering the 500 companies in the US, and then you'd be good to go? And that is a fair question, but there's a lot more to discuss here. So we are at the peak of the market once again, and this is usually where people look back over the past 5 years because they're thinking 5 years is long term, and then they look at whatever worked, and then they say, oh, that's the best thing. That is exactly how you should invest going forward. Put 100% of your money into that single thing that worked over the past 5 years. I do remember, though, a little bit longer ago, 2008 financial crisis. For a few years, most people were not really down on investing all their money in the S&P 500. There was some kind of like reasons there that, yeah, maybe there was a bubble that burst, and maybe the US market is not the only thing in the world, and maybe some diversification would have helped me going through this mess. So right now, what we see from the S&P 500 is actually most of it is driven by the Magnificent Seven, right? We have like seven companies that weight more than 30% of the index, generate most of the returns. They're trading at crazy valuation, and all of this is driven by artificial intelligence. It is good. It's going to help a lot of companies making a lot of money, being more productive and more profitable. That's for sure. But nothing is completely magical and perfect, right? You have to keep that into your mind. And I don't think this time is different. It's never that different. And most importantly, I do beat the index, but I'm going to get there at the end of this show today. We're going to talk about what's my benchmark and how I make, what's my results so far with my strategy. But I wanted to nail down if dividend growth investing is still relevant in 2025 for growth investors, so investors in the accumulation phase, and as a retiree as well, because it's two different type of investors, and I wanted to make the difference between both. So as a growth investor, as an investor in your 20s, your 30s, your 40s, is it still relevant? Well, here's the thing. I'm in my 40s, so I'm going to talk about what I see as a growth investor here. I love the focus on dividend growth. I love it because it gives me an additional set of metric. It's not that I'm going to always make great choices and never make a mistake and beat everyone on the stock market, but the strategy I use is super simple. I am able to analyze a company quickly just by looking at three different metrics, which includes dividend metrics in there. So the dividend triangle is focused on three metrics: the revenue growth trends, the earnings per share growth trends, and of course the dividend growth trends. So long story short, I know that a lot of people on this show is not your first rodeo with me, but the dividend triangle is based on the fact that as an investor, you want a company that grows their sales. So you track revenue. Once you make those sales, you want to make profit. So you're tracking earnings per share. And once you make good sales and then good profit, well, the next thing that you want to see is a company that share the wealth with shareholders, increase their dividend. So tracking the dividend growth. So you follow three metrics. You keep it super simple, and that makes a robust strategy because you only pick companies that are growing and they're generating more cash flow and they have more money to spend in their business, and they're also increasing your dividend. So your revenue over time will increase from those stocks as well. So it's kind of like the best of both worlds, where you get in control, you keep it simple, and you see that you have a basket of amazing company. Overall, in a year, I don't spend that many hours looking at my portfolio. Like every quarter, I'm going to pull out my DSR Pro report, where this is like membership website. So my team of analysts, they're doing a complete review of quarterly earnings for every holding that I have in my portfolio. So I read that report, and then I take action, or I don't. And most of the time I don't, because it's business as usual and I'm just happy to have those companies, and then I move on. And therefore I probably spend like what, maybe 20, 40 hours. I don't even know. Probably not, like probably 20 hours a year managing my portfolio. Once a year I do trades. Most of the time I don't even do trades, or I just rebalance, which takes literally a couple of minutes. And there you go. I go on with my life and it works perfectly. Now, once you retire, that's a little bit different, right? So you're changing your mindset. One of the toughest thing about retirement is changing that mindset from investing, so accumulating wealth, to decumulation. You start withdrawing money from your portfolio. And I know a lot of investors are just telling me, but Mike, at retirement, I just want to live off my dividend. I don't want to touch my capital, and I want to die rich. Personally, I don't want to die rich. I don't want to die a millionaire. I want to spend that money. I want to use it. I want to see the benefit of that money being spent on my children, on my wife, on memories, on activities, and helping my children buy their first home, or building their career when they're young and when they need that money. So down the road, I don't care if I die with like $100,000. I don't want to die with 2 million, because I want to use that money right now as I live. I mean, that's a personal choice. It's up to you. You can do whatever you want as well. But you know what? At retirement, the only thing that I have to change with my strategy, that is like super simple, and I don't have to watch the news, and I don't have to watch the stock market every single day. I just have to do that quarterly, read my report, and then rebalance my portfolio. The only thing that is missing at retirement is that cash reserve. So I have cash on the side. So on the bad year, I withdraw money from the cash reserve. On a good year, I sell shares, and there you go. When you think about that, at retirement, I will have this cushion, this cash wedge protecting me from any market crash. So market crash, I don't care. I have a cash reserve. So that's already settled. Second thing is, by sticking to the same strategy, I know that this strategy focuses on businesses that shows revenue growth, earnings growth, and dividend growth. How can a business that constantly generate more sales and constantly generate more profit and constantly increase the dividend it pays me must not be a thriving business? Of course it is a thriving business. So my portfolio at retirement will be packed with high quality companies. What else do I need? I have a protection for market crashes, and I have a fully packed, high quality set of businesses in my portfolio. On top of that, as a retiree, what I like is to have full control. I have full control of my holdings. I know exactly what's happening, and I have full flexibility on my retirement income, as opposed to if you focus on high yielding products, you don't have that flexibility. You let a firm dictate, oh, I'm going to pay you 12% yield. I'm going to pay you 8% yield. And if you need something else, oh, you need to sell shares anywhere. So you're back to square one, but you cannot dictate how much you want. With a mix of cash reserve and a portfolio packed with great companies, whenever I need money, I just sell shares, and I make that combination of dividend, selling shares, or using the cash reserve, and it's done. So I have the full control of the retirement income that I will have every single year. I can adapt my strategy going forward, and it makes my life a lot easier. And if you want to know more about those income products and how you can shape your portfolio, you can subscribe to my free newsletter at retirementloop.ca/income. So it's retirementloop.ca/income. You're going to get the 20 income focus guide for retirees, and you're going to have to subscribe to the newsletter for Canadians that are in transition to retirement or young retirees. So back to the final point of this show. Beating the index. First, I don't care. I really don't care. My focus is investing with conviction, sticking to a strategy that works and that will lead me to achieve my financial goals. So that's the first thing. The second thing is my benchmark is 50% Canadian, 50% US. This is how I created my portfolio. So it's unfair to compare it to anything else but 50% Canadian, 50% US. So 50% over the past 8 years since I started my pension plan, the XIU is up 12% roughly. VFV, including the dividend, including the currency fluctuation, up 16%. So you make the average, 14% to beat. And 14% for 8 years, man, that's kind of crazy. Amazing returns, right? We are blessed to live in the world where we can regenerate those kind of returns, and it's not always going to be that way. My returns, 14.5. So beating the index 0.5% every single year. I mean, that's great, but that's, again, not the point. I can reach my financial objectives with this, and I'm super happy with that. If you're beating me, good for you. I'm proud of you, but I don't care. I don't care because this is you. This is your situation. This is your money. You manage it as you want. And this is the point of investing. It's about knowing how you want to invest so you sleep well at night, you don't have to watch the market, and you spend minimum time so you follow a straightforward strategy. This is what I found in dividend growth investing, and I hope that you're going to find yours as well. Doesn't mean to be the same strategy. There are plenty of great strategies that works. The key point here is to stick to one for kind of like forever, right? So, right, Moose, that's enough for today. Tomorrow, we're going to have Nelson on the podcast again for an interesting discussion. So until then, don't forget to stay invested.